Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Monday, April 13th, 2026, and we're starting the week with some significant geopolitical developments that are rippling through markets. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story shaking markets right now is the escalation of US-Iran tensions, specifically the US decision to join in blockading the Strait of Hormuz. This has sent oil prices surging back above $100 per barrel, up about 8%, and that's creating a cascade effect across asset classes. We're seeing Bitcoin pull back below $71,000 as risk-off sentiment takes hold, and there's this broader flight to safety happening. What's particularly interesting is how different sectors are responding. Energy stocks are obviously benefiting from the oil spike, but consumer discretionary names are getting hit as investors price in higher input costs and potential margin compression. The geopolitical risk premium is back in a big way, and traders are having to recalibrate their positions accordingly.
That's a major development. How are you reading the market's interpretation of this situation?
Markets seem to be pricing in a potentially prolonged period of elevated oil prices, which has significant implications for inflation expectations and Fed policy. What we're seeing in the equity markets is a clear bifurcation. On one hand, you've got the energy sector rallying hard, and on the other, you're seeing pressure on anything consumer-related or margin-sensitive. Goldman Sachs just reported a 19% jump in first quarter profit, driven by record equities trading and better-than-expected investment banking performance, which shows that despite geopolitical turbulence, there's still robust activity in capital markets. But here's the thing. Morgan Stanley's analysis suggests that while earnings could shield the S&P 500 from war-related volatility, the key question is how sustained this oil price move will be. If we're looking at crude staying above $100 for an extended period, that's going to weigh on consumer spending and corporate margins. From a technical perspective, the S&P 100 is testing support around key moving averages. The Nasdaq is showing some weakness as tech names pull back on growth concerns tied to higher energy costs. And the Dow is actually holding up relatively better given its heavier weighting toward value and energy names.
What does this mean for traders and investors positioning themselves this week?
The actionable takeaway here is sector rotation and risk management. Traders should be looking at energy names as the clear beneficiaries, but also considering defensive positions in utilities and consumer staples. The volatility we're seeing creates opportunities for those who can move quickly. I'd be watching oil price action very closely because if we see any de-escalation in the Hormuz situation, you could get a sharp reversal. On the downside, consumer discretionary stocks are vulnerable here, especially those with tight margins or heavy transportation costs. The private credit market is also worth monitoring. There's some interesting analysis suggesting it's better positioned now than during the Great Financial Crisis, which could provide some stability if credit conditions tighten. For the major indices, the S&P 100 needs to hold above its 50-day moving average to maintain the current uptrend. The Nasdaq is at a critical juncture where a break below recent support could trigger more tech selling, and the Dow's relative strength suggests defensive positioning is already underway. I'd be selective here, focusing on quality names with pricing power that can pass through higher energy costs.
That selectivity is going to be key. Steve, let's get into the economic numbers. What's the picture looking like on the data front?
Thanks, Robert. Looking at today's calendar, we've got one key release that traders will be watching, and that's existing home sales for March, which came out this morning. Now, we don't have a forecast for today's number, but looking at the recent trend, we saw the March 10th release come in at 4.09 million units, which actually beat the forecast of 3.89 million and was up from 4.02 million previously. The February reading was softer at 3.91 million, missing expectations of 4.18 million. So we've been seeing some volatility in this housing metric. What's significant about existing home sales is that it gives us insight into housing market momentum and consumer confidence in making large purchases, which is particularly relevant given the current geopolitical uncertainty and its potential impact on consumer sentiment. The housing sector has been under pressure from elevated mortgage rates, but any strength here would suggest resilience in the consumer. This data affects real estate and financial sectors most directly, and given that housing represents a significant portion of household wealth, it has broader implications for consumer spending patterns.
And what's coming up later this week that we should be watching?
Looking ahead, we've got three important releases coming up. Tomorrow, April 14th, we're getting the Producer Price Index, which is a high-impact inflation indicator. The forecast is for 1.2%, up from the previous reading of 0.7%. This is critical because it measures wholesale inflation and can signal future consumer price pressures. PPI has been trending higher, with the March reading at 0.7%, which beat expectations of 0.3%, and before that we saw 0.5% in February. If tomorrow's number comes in hot, that could reinforce concerns about sticky inflation, especially with oil prices spiking. Then on Wednesday, April 16th, we're expecting initial jobless claims with a forecast of 215,000 versus the previous 219,000. This gives us a real-time pulse on the labor market. Also on Wednesday, we'll get industrial production data, where the previous reading was 1.4%. Industrial production has been strong, jumping from 1.3% to 2.3% earlier in the year. So this measures manufacturing sector health and capacity utilization. With geopolitical tensions potentially disrupting supply chains, this could be particularly telling about how the industrial sector is holding up under pressure.
Helpful context there, Steve. Now, Lizzie, let's talk about value opportunities. What's catching your eye in the value space?
Robert, I want to highlight Global Ship Lease, ticker GSL, which is presenting a compelling value proposition right now. This is an industrial sector play with a market cap of $1.4 billion, and the numbers are striking. We're looking at a price-to-earnings ratio of just 3.38, which is exceptionally low and screams deep value. The price-to-book ratio is 0.76, meaning you're buying this stock below book value. What really stands out is the return on equity of 25.51%, combined with a profit margin of 55.31%. Those are exceptional profitability metrics that you rarely see at this valuation. The company is generating a free cash flow yield of 13.63%, which is outstanding, and they're paying a dividend yield of 6.53%, with a very sustainable payout ratio of just 18.8%. The debt-to-equity ratio of 38.26 shows conservative leverage, which is important in the shipping industry.
Those metrics are impressive. What makes this particularly attractive in the current environment?
What's compelling here is that you're getting quality at a bargain price. The high profit margins suggest this company has pricing power and operational efficiency, which are moat indicators. The gross margin is 69%, which is exceptional and indicates a sustainable competitive advantage. From a Graham deep value perspective, this scores 70 out of 100, which is a buy signal. The PE under 10 and PB under 1 are classic deep value markers. From a Buffett quality standpoint, this actually scores 100 out of 100, a strong buy, because you're combining that exceptional ROE and profit margin with a reasonable price and conservative balance sheet. The cash flow metrics are also scoring 100 out of 100. The company is generating $187.4 million in free cash flow and $528.3 million in operating cash flow, which supports both the dividend and future growth. The dividend strategy also scores 100, given the high yield combined with that low payout ratio. In the shipping sector, which can be cyclical, having this kind of financial strength and cash generation provides downside protection. With global trade remaining robust despite geopolitical tensions, container shipping demand should remain solid, and GSL's long-term charter model provides revenue stability.
Let's shift to crypto now, Lizzie. What are you seeing in the digital asset space?
The crypto market is definitely feeling the pressure from these geopolitical tensions, Robert. Bitcoin has pulled back below $71,000, and we're seeing about $20 million an hour in selling pressure above the 70,000 level. The sentiment is cautious, and that's understandable given the risk-off move we're seeing across markets. For the week ahead, I'd characterize Bitcoin's outlook as bearish to neutral. The key level to watch is around $65,000, which some analysts believe could be forming a base as weaker hands have been flushed out. Michael Saylor from Strategy is signaling another potential Bitcoin purchase, which could provide some support, but the geopolitical uncertainty is the dominant factor right now. Institutional positioning seems measured, with firms like Strategy continuing their accumulation strategy, but retail sentiment has turned more fearful. The interesting dynamic is that Bitcoin was being tested as a geopolitical hedge, but in this immediate crisis, it's trading more like a risk asset. Ethereum is showing mixed signals. The big news is that Ether Machine scrapped its SPAC merger with Dynamix, citing market conditions, which isn't a great signal for near-term sentiment. However, from a technical perspective, ETH is approaching levels that could signal a trend reversal. The outlook for next week is neutral to slightly bearish, as the broader market uncertainty could continue to weigh on prices. Institutional interest in Ethereum remains solid given its role in decentralized finance and the ongoing development of Layer 2 solutions, but retail enthusiasm has cooled. The key will be whether ETH can hold key support levels around current prices. Solana is actually showing relative strength. Alameda Research moved $16 million in SOL tokens, which could indicate preparations for creditor distributions, but it also shows there's significant institutional activity around Solana. The outlook for SOL is neutral to slightly bullish for the week ahead. The Solana ecosystem continues to show strong on-chain activity, and institutional interest remains robust. Retail participation has been steadier in Solana compared to some other altcoins. The risk across all three is that if geopolitical tensions escalate further or if we see broader market selling, crypto could face additional downward pressure. Volatility is elevated, and traders need to be managing risk carefully with appropriate position sizing.
That's a comprehensive look at where we stand. Thanks to both Lizzie and Steve for breaking down today's landscape. We're navigating some choppy waters with geopolitical tensions front and center. But there are still opportunities for those who stay disciplined and selective. Remember, do your own research and consult with financial advisors before making investment decisions. These markets require careful analysis and risk management. If you found today's discussion valuable, please subscribe to the Morning Bell so you don't miss our daily market insights. We'll be back tomorrow with more analysis. Until then, trade safely.